Moms, if you are struggling with your credit card debt, I want to share with you a tip to help you save hundreds of dollars in interest. And it's easier than you think. Thank you so much for joining me here at Sisters for Financial Independence. My name is Catherine Agupjan, and I cover topics related to money, motherhood, and everything else in between. If you are into money and want more of it, then subscribe for more money content. The secret is actually very simple. It's knowing and understanding the concept of the average daily balance. In this video, I'm going to explain what that is, and I'm going to provide some action items to help you reduce your average daily balance so you can save money on interest and finally get rid of the credit card debt. What exactly is the average daily balance? The average daily balance is one of the ways credit card companies compute interest. For this particular computation, they take the total amount owed by a customer per day and divide that by the number of days in the given period. The higher your average daily balance is, the more interest you will pay. Before we dive deep into the average daily balance, I want to first review the credit card billing cycle. Now, I go through a credit card billing cycle more in depth in a separate video, which I will link up in the corner, but it's good to understand how the credit card billing cycle works because it informs your average daily balance. So here we have a visual of a credit card billing cycle. But we have from January to February, one billing cycle, the next billing cycle, and then the third billing cycle. Now, your billing cycle may not be as clean because the billing cycles normally start the minute you start using your new credit card. So if you use your new credit card mid-month, your billing cycle will start on that day. But for this example, our billing cycle is pretty straightforward. From January 1st to January 31st is one of our billing cycles. And during these billing cycles, you will be making your purchases. You'll be charging $20, $80, $25, $30, whatever you have as far as transactions for that billing cycle. When that billing cycle completes at the end of the month, your company will issue a statement. That statement will include all of your transactions, any payments you've made. In that statement, your credit card company will let you know what your balance is. It will let you know the due date for when this balance is due. It will also give you some minimum payments and other information. Now, typically, when your statement is issued, you have a grace period of 21 to 25 days before you need to pay your balance in full. And normally that due date will be during your next billing cycle. If you pay your balance in full and on the due date, that is great. It means you won't owe any late fees as well as any interest on any of your transactions. But here is what happens when you don't pay the balance in full. And this is where the average daily balance comes into play. So this is the same scenario here, but instead of us actually being able to pay our statement balance in full, we're only able to pay $100 and now we owe $180. So we are carrying a balance of $180 to the next billing cycle. And here is what happens when you start carrying a balance. So you owe $180 from the previous billing cycle. And now you are currently in the current billing cycle and you're making transactions, purchasing, maybe going on a grocery run, getting some prescriptions and putting on your credit card. The minute you carry a balance to the next billing cycle, anything you purchase, any transactions you make will start incurring interest. So now there's interest on this balance that you have as well as on these new transactions. And the more transactions you have, the more that will affect your average daily balance, which is the balance that your credit card company is calculating to charge for interest. And I will show you a breakdown of the average daily balance so you can see what that looks like and what you can do to ensure you are lowering your average daily balance to pay down your debt that much faster. Why does the average daily balance matters? Most credit card companies charge interest based on your average daily balance, not just your balance at the end of the month. So if you wait until your due date to pay the balance, your balance could be sitting high for most of the month, and that means you would be paying more interest. Now, unfortunately, many of us don't actually read the fine print when we get a credit card. So it's important to know how your interest is calculated on your credit cards. Download your statements and read through it to see how your interest is calculated so you know exactly how to save money there. I want to show you a quick example of how interest is determined on credit cards. So when you pull up your statement, towards the end, normally the last page, you will see a bunch of fine print. And you're going to read that fine print and you're going to see how your credit card company charges interest. Now, majority of credit card companies normally use the average daily balance method, but you'll just need to verify it for each of your separate credit cards. So make sure you pull all of your statements, print them out, and read through the little fine print. Here is the explanation of how interest is charged on your credit card. And you will also see a little blurb that says, how do you calculate the interest charge? For this particular credit card that I have, they use the average daily balance, including new transactions. Now I'm going to show you what that looks like so you see it in action and you know exactly how the average daily balance is calculated. When it comes to credit card interest, there are a few things that your credit card company is going to look for in order to calculate your interest. The first is the calculation for the average daily balance. The second is called the daily periodic rate. And this is the APR listed in your statement divided over 365 days. So they are going to pull your APR for a daily basis. And then the last thing they're going to have is the number of days in a billing cycle. And normally this will be 28 to 31 days. You will see the number of days in the billing cycle on your statement, and that will be what they will use to calculate your credit card interest. Right now, we are in what's called a high rate environment. For a majority of users who have a balance on their credit card, some of their interest rates can be between 20 to 30%. That's a lot of money accumulating in interest alone. Let's go through an actual visual so that we see what that can look like when we are trying to calculate our average daily balance. Now that we know the information that your credit card company needs and uses to calculate your credit card interest rate charges, let's look at a visual to see what this looks like. So here I have an average daily balance calculator. I have scenario 1 and scenario 2. I'm going to show you what that is in a little bit. But first, let's go through scenario 1. So here we are going to need our APR, which you can find on your billing statement. You'll also need the days in the billing cycle, again available in your billing statement, and your beginning balance. For this example, we have 28 days in the billing cycle, and we have not made any purchases or made payments to this. So our balance during this billing cycle is 180, and it averages 180 because we're not adding or making payments. I have here a calculation for your average daily balance, and this is what your credit card companies are doing. They are totaling all of your balances across the 28 days and dividing that by the number of billing days, which is 28 days in your cycle. And you arrive at the average daily balance of, in this case, 180 because we didn't add any purchases or make any payments. Now, below that, I also have an area for calculating your monthly interest charge. So the charge that your credit card company is adding on top of your balance due to the interest rates. So you enter your APR, which again, you divide that by the days in the year. So in this case, 365. And when you do 25 divided by 365, you get your periodic rate. And then you also then multiply that by the number of days in your billing cycle, which is 28 days, and the number of your average daily balance, which in this case is 180. So for this particular balance, at a APR of 25% in the billing cycle of 28 days, you will owe the credit card company an interest charge of $3.45. So that's your scenario 1. This is your scenario 2. Everything remains the same, but you are making purchases on this card. You're carrying the balance, but you are also making a $20 purchase on day 5, a $50 purchase on day 14, and a $50 purchase on day 25. You will see that your balance starts to increase. So the balance goes from 180 for a few days. You add a $20 purchase. Now your daily balance is going up to 200, you make another purchase and so forth. And in the end, after all the purchases, you now see that your average daily balance has increased from 180 to 231. This increase in your average daily balance also means you now pay more in interest charges. So your daily balance of 231, you now owe $4.43. So that's $1 more you're paying in interest because you put in some transactions within your card. In this case, $120 worth of transactions. So this is the difference when you continue to use your card and you're carrying a balance. Automatically, interest gets charged on the transactions that you are making. I want to take those concepts and apply it to a larger balance. In this case, a beginning balance of $10,000, APR of 25%, and the days in the billing cycle is a little bit more at 31 days. Now, here is where we're going to kind of see and play out a scenario for payments. So say you stop using this credit card, you're not making any purchases, and you are now gung-ho on paying it. Now, Plan A and Plan B are basically two plans that I have decided to follow through to see how will I pay off this credit card debt of $10,000. For Plan A, I have decided that I am going to put some money from each of my weekly paychecks directly to pay down this balance. So on the 7th, I get paid, I pay $500. On the 14th, I get paid, I pay $500. And on the 21st, I get paid, I paid $500. You will see that the balance starts to go down with each of your payment. When you put payments towards your balance, you essentially lower the average daily balance in the end, and that's going to affect the interest charges on your card. So here is what I've done. I've put around $1,500 of payments, but I have divided it across multiple weeks, and some of them I put in earlier. In this scenario, in Plan B, I'm going to take that $1,500 and do a lump sum payment towards the end of the billing cycle. You will notice a key difference here. Again, from here, you will see that the balance starts declining, but here the balance remains $10,000 for 27 days, and this will affect the interest charges. So let's go to the bottom and compare what it looks like. So here is my average daily balance. I put in the same amount, but I've put it in earlier in the billing cycle. So in the end, my average daily balance is $9,129. For the Plan B, I've put in my $1,500 payment later in the billing cycle. So my average daily balance is $9,806. And if you scroll all the way to the bottom, the interest that was charged in that cycle for the plan where I put little increments of payments is $193 versus $208. So you can see that in the scenario of Plan A, putting your payments as soon as you have it helps reduce the interest charges on your cards. And you will see how drastic this is when you look at your average daily balance calculator. You want to reduce your average daily balance quicker. So any chance you have to put in some money towards paying off your balance can mean a long way from saving interest and helping you pay down your debt finally. Think about that across all of your credit cards. The faster you can send payment, the lower your average daily balance will be and the lower the interest rate charges will be, which means more money you can put towards debt or to save. I will have a link of this sheet in the description so you can test and play around with it and enter your beginning balances so you can see and have a plan in place to pay off your debt. So what should you be doing to lower your daily average balance? Your first action item is to make multiple payments. Don't wait until your due date to submit your payment. Send smaller payments as soon as you have it to keep your balance down. That accumulation of interest on a daily basis can add up quickly. So the sooner you lower your balance, the less will be charged in interest and the more money you will save. Number 2, Pay your credit card immediately after a big purchase. If you put a big expense on your credit card, pay part of it right away so it reduces that balance. Number 3, try to round up your payments. Maybe you can increase it by $10 or $20. Those little bits do add up, which can save you a lot of money in interest over the long term. Number 4 is to use any extra cash you get wisely. Whether you're getting a tax refund, maybe you sold some of your kids' stuff, or you have just extra money coming from a side job. Put that money to work by dropping it immediately to your credit card company. Don't wait until the due date so that over time you reduce the balance and save money on interest. Number 5, consider returning some of the stuff that you've purchased. I know oftentimes we go to the store, we may buy on impulse, and that can increase the balance on our credit card. Take a look to see if you really need those items. Take advantage of store return policies. Don't abuse them, but take this as an opportunity to return items and get credit back to your card so that you can also reduce that balance and again, save you money on interest over time. As moms, I know that we are always looking for ways to stretch our dollars. Bring your average daily balance is a simple habit, but effective habit to help you save money without overhauling your entire budget. Imagine being able to cut your monthly interest in half. That's more money coming to your family to use for groceries, for kids' activities, for other things that you actually need. Small steps make a big difference, and by understanding the average daily balance, you can make those steps towards lowering your balance and finally eliminating the credit card debt. If this video has been helpful, hit that like button so more moms like you see it. And of course, share it with a friend so that they also understand how the average daily balance works. I just want to do a quick side note here when it comes to cash advances. Cash advances normally have a different rate and a different interest calculation. For a lot of credit card companies, cash advances accrue interest immediately. So please review your terms, know exactly the difference between interest rates for standard purchases as well as cash advances so you know how interest is calculated and how you can find a way to pay it faster. If you're serious about tackling credit card debt, I want you to check out this playlist, which has a whole list of videos with strategies to help you pay down your debt and finally eliminate those credit cards. Don't forget to subscribe to Sisters for Fi for more money content to help you manage your money better so you have more for it, for your family, and your community. Thanks for tuning in, and I will see you in the next video. Bye!